All right. So, welcome to the call, Jay. Jay's been a good friend and a great partner over at Synovous Bank. I'm going to be asking Jay just a few questions about kind of the state of premium financing, as well as what makes Synovus different as a lender. So, welcome, Jay.
Well, thank you very much. I appreciate it.
So maybe let's maybe start out with talking a little bit about how you got into the premium finance life insurance game, kind of what you've seen happen in your own career from the time you got in, and how you feel about premium finance life insurance as we sit kind of today.
Right. Well, I guess I've been in premium finance or specifically with this firm for over 26 years. So that'll give you a good idea of what I think about the industry, about the concepts of premium finance. Prior to that, I worked in the high-end planning group for New England Financial. Entire client base, they did very specific marketing. Entire client base was psychologists and psychiatrists. Early on, when you go way back into the 90s, I call it a smaller version of premium finance, but it was you would utilize a company's accounts receivables to create the catalyst that established the arrangement. When way back before Synovus Life became Synovus Life, and they were starting to market that concept nationally, they tied into the New England Financial Group to basically roll that out across the country. And that's kind of how I got involved. That was back in 97, I think, that I originally had a chance to see what those types of concepts looked like, how they worked, how they can play out for a client, and got hired away a couple of years later and have been with the firm ever since.
Cool. I know Synovus does some really unique things that a lot of other lenders don't offer. The first thing that comes to mind is the 10-year loan term.
Right.
Can you maybe touch on that? What you see as the benefits of having a committed multi-year type of loan?
Yeah, I mean, I think one of the main things is mitigating exposure in any type of financial plan. And you do that by minimizing the different factors that roll into it. Um, you know, in my opinion, our loan is best in class right now. It's a 10-year term. So the client's not having to look at going back and refinancing it every year, every 3 years, every 5 years. Underwriting is one and done. So we underwrite at the beginning of the loan, and then that's it. It also has an auto renewal function so that at the end of 10 years, it renews to another 10 years. So again, the idea there is you're removing different obstacles that can cause the client's plan to go off the rails. Rates drastically change, lender doesn't underwrite again, different things like that you've taken off the board by going with a 10-year term.
It seems like for some clients that are worried about, oh, what if I don't qualify for the loan 5 years from now? Though that's typically not a common thing to happen. I think it does give them, just from an emotional standpoint, gives them some assurity that that loan's going to be there for at least for the first 10 years, and then even beyond that with your auto renewal, it's going to be there for
Right,
the duration of the premium finance structure.
right,
And,
right.
what
And
kind,
it
what
also
kind of
it
feedback
also
have you
get,
gotten on that?
I'm sorry, say again.
What kind of feedback have you gotten on that, giving that client that assurity that the loan's going to be there for them?
Well, I think that really is kind of the huge part of that is when you go to a shorter term, you're always putting yourself at the risk that a lender might change their mind. They change their underwriting. They change their underwriting credit. They change the collateral that's required. So there's a whole bunch of different things that now start going into that renewal. That's again, so you're right. Most people at 5, you're not worried too much financially because in most instances, the policies have done better, the client situations have done better, but the bank might change its mind. So again, that's something else that you take off the board. The 10-year term, I've never heard a client not like a 10-year term. I've never heard them not like a longer term. So
Right.
the idea that you still have a long term on the table, you're underwriting one time, but you have the ability to modify or restructure as the loan goes along, that adds the additional flexibility that the advisor and the client needs as they need to adjust through the life cycle.
I know you guys used to have a prepayment penalty that came
Mhm.
with that committed 10-year uh, loan term. You guys recently waived that, yeah?
That's correct. At the beginning of the year, portfolio management gone back. They took a look at the portfolio and they said, you know what? And we learned this over the last couple of years when interest rates really kind of went crazy, was you had clients that needed to come in and modify or restructure their transaction for whatever reasons. Maybe they needed to increase it, or maybe they've decided, okay, cash flow's different now, whatever. They wanted to be able to modify. Having the prepayments in the past did not allow for that modification. What we did back in January of this year was we actually said, okay, we're only going to focus that fee on the funded portion. And that gave the advisor and the client the ability to alter the plan going forward. But then we came back and looked at it again and we said, the portfolio is really sticky. We can still offer our 10-year term and remove the prepayment fee outright. So all the new loans that are closed, none of them have the prepayment fees in them.
No, that's great. Couple other things we found with very specific clients. Let's say you have a client that wants the policy to be owned by their operating business.
Mm-hmm.
Some lenders won't allow that to happen.
Mm-hmm.
They'll need it in an irrevocable trust or some sort of separate entity that doesn't have any, liabilities or risks associated with that entity. You guys are able to allow that operating business entity to own the policy and be the lender as well, right? Why
Correct. The idea
is that?
there is again to be flexible and versatile. You can go with an ILET, you can go with a corporation as a borrower. You have the ability to do those adjustments as to who the owners are on the policies. We're one of the few that will actually also do 1035 exchanges, which sometimes in the routine of the life of the loan or in the life of the financial plan, that's something that needs to be done. So we have the ability to adjust and do that.
I also know that you guys are pretty friendly in the wealthy global citizen slash foreign national market. Maybe could you share a little bit about how you look at that market and what your requirements are to be able to
Yeah.
fund a policy like that?
Yeah, the foreign national market, it's always an interesting market because as much as you try to streamline your approach to the foreign national market, at the end of the day, for all lenders, I can speak for all of us in that every one of them is kind of a one-off because they're all very, very unique. What I always encourage somebody to realize, though, is that the know your customer rules for banking are different from insurance. So an insurance company might come in and say, okay, we only need a $25,000 US Nexus in order to put a policy on an individual. Well, that doesn't really apply for banks. Banks are typically much higher than that. And so that's one of the things I always recommend is if you have a foreign national that you're looking to use premium finance for, and premium finance does work great. I mean, it's got a lot of caveats for that market. The first thing you want to do is reach out to the lender and say, okay, give me a general idea of what your guidelines are for that individual. I'm using such and such carrier. That way, you know right out of the box what you're going to need to do. That market itself is evolving. And I think over time, as the carriers do more and more business, as the lenders do more and more business, things will become more black and white. It's just fairly new to everyone right now.
Going kind of pivoting over to kind of the state of the union, right? What's happening in the premium financing market now? Our premium financing business continues to grow, just in compound, quite frankly, both in case count as well as case size. I'm hearing that premium financing as an industry overall is down significantly
Mhm.
over the last couple of years. And I think it's because a lot of folks were selling cheap money, right? They're selling it based on the rates. We never sold it based on the concept of cheap money. We sold it based on the concept of, using OPM and reinvesting that money in a person's business or, some sort of alternative investment. But we never sold the idea of premium finance life insurance solely based on market rates.
Right.
What have you guys seen, and what's your take on why someone should be premium financing their life insurance policy?
Right, right. So yeah, I mean, there's kind of a circle back on something in there as well. The idea is, and I think sometimes people get off track. They think the arbitrage is the difference between what the policy is getting and what the loan cost. And that's not really it. I think you kind of hit on it when you said other people's money. The arbitrage is if I need to purchase life insurance because I have a life insurance need, what is the most financially beneficial way to do that? Well, if I've got a stock portfolio over here that's returning 9, 10%, if I'm going to have to sell that to go purchase my life insurance, which might be doing 5, 6, 7%, whatever, depending on the product, would it make sense to do that? Or would it make sense to go out to a bank and borrow the money at less than that, to borrow it at 6% or borrow it at 7%? So that is really kind of where the arbitrage is. The arbitrage is what other assets would I be using to purchase this life insurance that I need? And in some instances, is it better off then that I go out and I borrow the money from a lender and utilize that so I can reinvest my money back into my business or whatever assets that I've got that are growing at a higher rate of return?
Right. One of the things I never hear people talk about when it comes to premium financing is the tax treatment on borrowing the funds, right? If you
Mhm.
if you if you borrow the premium, obviously you've got to pay the interest, or at least you're supposed to if you're doing it responsibly.
Yep.
But you're not paying taxes on the borrowed premium.
Hmm.
You said something I thought that was really interesting and really valuable, and that is the money that's deployed back into the business. Typically, if it's deployed back into the business, they're buying business assets that are deductible because they are business expenses. So you're
Right.
taking a dollar that would have been chopped in half in terms of taxes that you would have needed to pay the premium. You're
Right.
keeping the full dollar in the business and deducting whatever business expense that is being spent on for the betterment and expansion of your business. So you're actually kind of double dipping from a tax standpoint. Um, if the purpose of them doing this is to deploy more cash back into their business.
Right.
Have you heard very many people talk about that concept when it comes to taxes?
So, yeah, I mean, yeah, especially in the past, I would say, and it was kind of circling back on what you were saying as far as what does the portfolio look like? The portfolio over the last years has kind of shifted a little bit away from true business owners to more ILET, so more estate planning, wealth transfer types of situations. In those situations, you typically won't hear them talk about any of the tax or the benefits or kind of that situation because it's usually involved with an ILET. But when you go back over to the business sides, then you get exactly that. I'm reinvesting the stuff back into my corporation. I'm growing the business, and it hits on everything that you're talking about. I wouldn't say a lot of advisors, at least that I'm aware of, get into that, especially as we sit on the lending side. That's kind of, I look for the advisors and I look for the tax professionals really to speak more towards that. But it's something that's always existed.
Yeah, I mean, yeah, that's definitely not the lender's responsibility to talk about that. But I'll tell you, being on the advisor side of the table, I never hear advisors talk about that tax play, and it's so
Hmm.
important. Again, if they keep that money in their business and they're buying whatever equipment, right, and they're
Yep.
depreciating that, they're getting a major tax
Yep.
benefit from that versus taking that dollar, losing half of it to Uncle Sam, and taking what's left over to
Yep.
pay the full out-of-pocket premium. The premium financing and lending side is just it's so advantageous from a tax
Yep.
standpoint. So, yeah, I just don't hear people talking about that.
Well, and I don't think a lot of advisors understand it, at least in that context. So, they don't really kind of dip into it, but it all becomes math, right? I mean, I used to always say, you're practicing math, not magic. So, you can sit there and just look at really how are the different dollars affected, and then you make an educated decision.
Yeah. There will be literally thousands of advisors that will watch this video of us having this conversation. So if
Mhm.
you're an advisor out there and you want to know more about that tax situation, absolutely reach out to us over here at Landsmark Capital. We're happy to sit down with your CPA or whoever your tax professional is, and talk about that tax benefit.
Mhm.
Um, from a good, bad, and ugly standpoint, focusing on the bad and the ugly, right? We know that
Right,
there's lawsuits out there in the public domain right now that involve premium financing, and
right.
clients are suing the advisor, they're suing the carrier. We see a lot of these cases that were improperly designed from the very
Mhm.
beginning, running into these problems. And quite frankly, I mean, there's several firms out there that are still selling this concept of quote unquote free insurance,
Right,
almost as if to say, oh, buy this, $20 million house with a mortgage loan and don't make your mortgage payment. I mean, that is
right.
absolutely insane and insanely irresponsible. What have you seen on the lender side, even if it's, kind of secondhand information? What have you seen
Right.
on that level?
I mean, I think what we saw, and it's kind of, the cases that you're talking about now, is because money got so cheap, everybody thought they could sell premium finance. And so, whether the agent was inexperienced, whether they presented the concept wrong, whether they didn't want to use a premium finance firm that specializes in it, all these different things. So, what you have out there, what you would see a lot is basically overpromising and under-delivering. They weren't shock lapsing the interest to see what would happen if interest rates weren't at 3 and 4% anymore. They weren't going out and looking at the policies and adjusting the policies accordingly. They weren't calculating collateral the way that it needs to be calculated.
Right.
So what happened was they really, were just kind of getting out over their skis with some of these clients. And you're right. I mean, some people do market it or did market it as free insurance. There's never been free insurance. I mean, there's got to be an insurance need. What is that insurance need? Once the insurance need is established, then you can sit there and say, okay, how do we need to pay for it? And what's the most beneficial way to pay for it? So I think what happened is that you've got a lot of those. I wouldn't say a lot. That's probably painting it with too big of a brush. But the ones that bubbled up and have had troubles were ones that were sold as a straight arbitrage. Interest rates are never going back up, and the policy's always going to do phenomenally well.
Yeah. Yeah. No, absolutely. I know you've seen our proposals, but we always show three different interest rate environments,
Mhm.
kind of low, medium, and high. And in the high end, we show a borrowing rate that perpetually increases and gets north of 7.5%, which I don't think that's that realistic personally, but I mean, in theory, it could happen.
Yep.
I want it stated in our document where we're showing the client extremely adverse scenarios because I
Right.
never want to get accused of only showing, rosy, rainbows and unicorns type of scenarios.
Mhm.
We want to show some really pessimistic scenarios so the client understands. Not
Yep.
not that the client should expect that negative scenario to happen, but I think it's important from just an illustration standpoint. This is what it looks like if this highly unlikely thing were to happen,
Mhm.
and you have to be able to be in a financial position to pay that higher interest payment if this were to happen. And if you don't
Absolutely.
have the funds to do that, then perhaps you should not be premium financing, right?
Correct. Correct. And I mean, and that's just it. I mean, that goes back to, you know, 101. You've got to be educated. So the key is for the advisor to be educated and then to eventually educate the client, the borrower, is to understand, hey, these different things can happen. What are you going to do or how are you going to feel if it happens?
Yeah.
So that you can again, it goes back to what we were saying when we were talking about the loan. How do you mitigate the risk? And that, again, is a way of mitigating the risk when things aren't all rosy and things go crazy and go crazy for a period of time. How does that work out?
Yeah. You made a comment about advisors thinking they can do this on their own, that don't live in the premium financing space, 24 hours a day like I do. Could you touch on that a little bit? What's your take on advisors that think that this is not as complex and as sophisticated as it actually is? What do you tell advisors that says, "Oh, I can do this myself. I just get a lender and fund the premium."
Right. So in most instances, an advisor has a couple of different resources to utilize. Now, the question is, will they utilize those resources? Obviously, they might have in some of the carriers, also it's directed by the carrier, right? Carriers might have their advanced sales group that helps them put together, and that's a way to do it. Others utilize premium finance firms and they say, look, these guys know what they're doing. This is all they do 24/7. You need to go work with them. Then you have the other ones that go out on the path all by themselves and try to put it together. And, that's not always the best decision. Now, you do have some of the guys out there that, long-standing independent advisors that have done premium finance for a very long time and they know what they're doing. Those are not the ones that are you see getting popped up on the internet as part of some litigation and everything else. Again, it has to do with I won't say the inexperienced because I would say they're even once you go beyond that, you can do a couple of these and you're still not totally experienced in how to put this together. But it's the ones that just try to go off on their own for whatever reason, and they end up, I don't want to say they end up getting burnt, but they can get burnt. So I think the carriers are now at a point where they're saying, okay, you're either utilizing our internal advanced sales guys that are going to handhold you, or you've got to go utilize a firm that knows what it's doing.
Yeah, I would say, just about anyone can draw a picture of an airplane, but doesn't mean they can build an airplane. It doesn't mean they can manage and work on that airplane. And it sure as heck doesn't mean they can fly that airplane, right? I mean, yeah, advanced sales markets teams with carriers, these are great people, very smart
Mhm.
people. But someone has to be someone has to be flying that plane, and
Right.
that's not their response. That's not the carrier's advanced market team. That's not their responsibility to fly the plane.
Yep.
It's almost like, and again, not to be disparaging towards these groups whatsoever. They're fantastic people, very talented people,
Mhm.
but they can only semi-instruct, right?
Right.
It's almost like if you're sitting in the cockpit behind the wheel of a 747 jet, you can have someone, on the radio telling you what to
Mhm.
do, but that doesn't mean you're going to be able to fly that thing. Even if you have the
Nope.
best instructor in the world telling you what to do, you got to have someone that's actually a real pilot flying that plane.
That's true. Well, and I think it's one thing that you guys do as well as there are a whole bunch of, I won't say there are a whole bunch of different ways to model and put these together, but there are. There's not
Absolutely.
just one tried and true way to do it. So the ability to sit there and say, okay, we've got this situation, so let's handle it this way. We've got this situation. That was one thing that we learned coming out of the crazy interest rate environment was we really worked on building out our client services group because as things went along, we said, okay, we need someone there to help the premium finance firm, to help the advisor, to remap these things as they go along, as things change. So, again, that's the way coming in the front end. What's the best model to put together as the situation sits today? Okay, now we're going down, we're 5 years into it. Oh, we had a kid, so now we need to add something different over there from an estate planning purpose, or, it's a business purpose. We no longer have that business partner anymore. How do we alter to go along? And so I think it's important that you have those expertise all along the way.
Yeah. Yeah. I think a lot of advisors don't realize how many pivot moves there are available in a premium financing arrangement
Yep.
when the client's circumstances change for the better or the worse, you
Yep.
know? I mean, we've had clients that during COVID that literally they went out of business and they
Yep.
had zero cash flow coming in. Conversely, we had other clients that did wildly well financially during the pandemic. Um, we even have a client that did really well in the crypto area and
Hmm.
decided when rates went up, he just paid the whole thing off.
Yep.
And he's sitting on the sidelines and he's expecting rates to come back down and he's expecting to jump back in and
Yep.
have the his future premiums financed. But being able to help that client navigate that, I
Yep.
think is so important. And that's not the lender's job to do that design work. It's not the
Right.
carrier's job. Someone has to do that work, and it's got to be someone that's an expert, in that space.
Yeah. To me, premium finance, it should be a quiet, part of your financial plan. It's not
Great way to put
something,
it.
it's not something that needs to get tinkered with every month. But
Yeah,
just like your old school insurance, you're going back at, once a year, you're looking at it, you're looking at the situations, you're making adjustments accordingly. And, I think that's kind of the key there is, it does have a lot of pivot points, but it has a lot of pivot points because there's a long period of time that gets utilized. So, and then you have things like, Bitcoin that, goes sky high and he's able to do exactly that. So we have seen that as well. We've seen products have done well that people have unwound because of that. We've seen people start paying premium out of pocket with the idea that now that rates have come back down, they're going to start refinancing it again. Again, that flexibility is there and should exist as the life cycle changes.
absolutely. Absolutely. What advice would you give an advisor? Maybe they've done one or two cases, premium financing cases over the last, call it 5 to 10 years,
Mhm.
kind of one-offs. And let's say they wanted to ramp up their premium financing portion of their practice. What would be the most important pieces of advice you would give them if they really
Right.
want to get involved?
Well, I mean, I think that's where they got to get involved with a premium finance firm. You really got to see one, what does your book of business look like? Does your book of business allow for something like that? If not, how do you develop that book of business? Then, once these opportunities arise, what is the best model that we're going to put in place and how do we educate that individual? At the end, you've got the lenders coming in. What are the different lenders out there? What are the different options? How do those different options play for your client? I think that's where the premium finance firms really come in. Cookie cutter is not the right word to use, but it does streamline that entire process. Goes along with additional collateral calls that might be done yearly on through, to eventually, again, not the right term to use for insurance, but it is kind of a cradle to grave type of relationship that you're talking about there.
Yeah,
So I think that when things get streamlined, things don't get left out, makes it easier for the advisor, ultimately makes it easier for the client.
yeah. Anything we didn't touch on that you'd like to touch on in terms of what makes Synovus different?
You know, we've always been quick to turn. So typically, and you know this from dealing with us for a long time, typically things are submitted. We're going to turn preliminary rate sheets within about 72 hours. Once we have full closing docs, we're ready to go to closing within about 72 hours. Now, that sometimes isn't a big deal as people start the financial underwriting at the same time they start the life insurance underwriting. But sometimes as you get towards the end of a year or a tax season or whatever the case might be, that the client wants to go ahead and button things up, those things come into play. Like I said, I really do feel like we're best in class right now. There's a number of good entities and lenders that are out there right now, but I do feel like, especially removing the prepayment fee with the 10-year terms, the one-time underwriting, the auto renewals, it really does become best in class. And I think as you guys have realized and as advisors realize, you know, it's important to be there to help you guys out along the way. The firms and the advisors are doing all the heavy lifting on the front end. What we don't want to do is make it heavy on the back end. So how do we streamline that? How do we look at the model that you're bringing in and go ahead and have things in place specifically for that? Now, we've talked about it before, different ways to forecast collateral and that sort of thing. Well, if I know on the front end how you guys do that, I can build that into the system so that I don't create any surprises on the back end.
Yeah. Yeah. I mean, obviously, the rates are important, but
Mhm.
clients forget, I shouldn't say forget.
Yep.
If the rate is great, but the process and the experience for the client is cumbersome and a pain in the butt, they very quickly forget what a great rate you got them.
Yep.
Conversely, I mean, you can't give them a terrible rate. But
Absolutely.
if you're giving the client a less cumbersome, better experience
Hmm.
from the beginning to the end and then all the way through the renewals, that is by far more important than some
Right.
unbelievably low rate and they feel like they're being neglected, right? It's like that Maya Angelou quote, right? People will over time they'll forget what you say, they'll forget what you did, they'll never forget how you made them feel.
Yep.
And
It's
there's a
true.
big part of that is quantitative as and mathematical as I am, I do understand that human
Yep.
emotional side of people want to feel like you care about them and you're doing the right thing by them and
And I
process
mean, and
is
you're
a pain
hitting
in the
on it.
butt. They don't feel
Yeah.
that.
Yeah, and you're hitting on it. I mean, rates today, you go through just about, again, through us, through the competition, we're all within, I always say I'm from the South, so I always say we're in spitting distance from one another. But
Yeah,
it's true. I mean, everybody's rates are right there together. People use different indices. That doesn't really matter. The spread is really kind of what you're looking at. And again, what are the other things that you're going in there to mitigate the risk? To mitigate the different things and to make it easier. And
yeah,
so that's where I think once you really start sitting down and talking to the different firms, you start going, okay, I see what you're talking about. I see, are you taking a consultative approach? Are you just, transactional? That sort of thing. So I think that's one thing that we've really done a good job. We were always consultative in nature. And I think, again, over the last couple of years, we've really kind of gotten our arms around that white glove. I think the word concierge is sometimes overused, but I do think that it adds value and it is fitting here. So, again, I think once the process is started, you see how smooth things can actually go.
yeah. Yeah, I think we've had a great working relationship with you guys over the years. Just kind of we wrap things up here. What would you say, I don't know, one, two, three things that Synovus Bank has appreciated about the way that we do our premium finance business over here at Lionsmark?
Absolutely, absolutely. There's the old saying, junk in, junk out. There's no junk that comes in. You all do a fantastic job of qualifying the advisors that you're working in with, and then ultimately qualifying the borrower themselves. The way that y'all package everything up makes it very easy when it hits the desk over here. Things aren't piecemeals. It's not onesie twosies. We've got a full package. We know what we're looking at. And if we have questions, we can get back with you and your team and get immediate answers. So the fact that we're able to go back and forth so quickly keeps the process from slowing up and removes the obstacles. And at the end of the game, it's which is most important for all of us lenders is stickiness. Does the loan come into the portfolio? Does it stay into the portfolio and does it grow? And the answer is yes. So, we've had situations before where loans come in and out. They get put in, all of a sudden they get refied back out, or the client doesn't stay in it for whatever reasons. That's obviously no one's looking for that type of situation. So you're looking for ultimately a borrower that's going to be in that portfolio for a very long time. And you
Yeah.
guys have done an excellent job of that.
Oh, appreciate that. Appreciate that. Yeah, as we wrap up here, I will say, the fact that you personally have been so hands-on with us and you're always reaching out, what can we do better? What can we do better? I mean, you know this in business, that is not normal, right? That is not normal to be that attentive, that hands-on, and
I
that
appreciate it.
uh, I'll use the word humble. I don't know if that's the right word or not, but
Thank
humble
you.
enough to say, "Hey, tell us how we can do better." That
Mhm.
that that bluntness and candor and humility, I think, is something. If we all just operated more from that standpoint,
Right.
business relationships would be a lot stronger, a lot better, and I think we would all do better business together. So I really appreciate that part of what you do,
Well, I,
who you are as a person.
Thank you. Well, you hit on it, and it's a relationship, and it is a relationship, and a relationship requires work, and it's going to change, and different things are going to come in, and different things are going to go out, and people are going to mess up, and then they're going to get better at it. And so the only way to do that is to have that ongoing communication and saying, okay, what are you seeing now? How do we need to adjust accordingly? How do I not make your job tougher? And that's again what I think you guys are doing with the advisors is okay, how do we do this and be effective in it and smooth it out as much as possible?
Right.
We're dealing with people, and at the end of the day, people all can, throw these things off course. But I think that's exactly it. I really do appreciate it. And your team has been fantastic with the communication back and forth, very quick to reply back or very quick to get information back, which is always, one of the key things for working with a lender is, the resources on the other side and the speed that things are communicated back and forth. And so you guys have done, we appreciate it. I mean, it's the reason that, that I do like to work with you and I like working with your team is y'all are professionals, but you're also enjoyable to work with. So I think that's kind of the key.
Appreciate that. Thanks for joining us today, Jay.
Absolutely. I look forward to it. We'll
All
see
right.
you in Dallas.
Sounds good.
All right. Bye bye.